You know, Craig, it kind of seems like you may be aligned with those retail investors in this case. You're maintaining your S&P price target. You see a double-digit move to the upside for the S&P by year to date. You also say we're kind of in an intermediate term low. I want you to kind of explain that. What does that mean? Does that mean the tariffs on April the 2nd, are they already priced into the market? Does that mean that earnings are going to surprise to the upside and we won't see any turbulence there? What's an intermediate term low?
Sure, Frank. So what we mean in terms of an intermediate term low is when we think about this market, breaking it up in terms of trading, short-term trades, intermediate term, and longer-term trades. There's no question that the longer-term trend, which is the secular long-term trend, still remains intact. And we highlighted that in this month's Informed Investor publication. When you break it down to more of the intermediate term, think about the bottom that we made in October of 2023, or the corrections we made along the way in 2024. This to us just looks like a correction within the context, Frank, of a longer-term secular uptrend. Keep in mind, it took only 22 days to get a 10% correction in this market. And our research shows that when you go back through time, that was the sixth fastest sort of 10% decline we've seen. And if you look back in time, the five previous times that we've seen corrections that quick, we did see the market recover very, very quickly. In fact, the faster the slide, the faster the recovery is what we've seen. And I would not be surprised to see a recovery of this market in the next, call it 2 to 3 months, back to the old highs.
All right, so you see us going back to the old high. So I just want to be clear. I mean, does that mean that the tariff disruption or the market disruptions from tariffs is already priced in? And that sounds like you also think that earnings are going to at least come in line or maybe better.
Well, I definitely think a lot of this negativity has been priced into the market. If you go back and you look at the AAII sort of bull bear index out there, and again, yeah, that's a retail leaning. But again, a lot of institutional investors look at it, Frank, and it tells us right now that we're sort of at max negativity levels that are similar to what we had seen in the COVID lows, and similar levels to what we'd seen during the lows of the great financial crisis. I don't know about you, Frank, but I do not think that we are entering some sort of new slide like the COVID lows or the great financial crisis or those kind of things. And in terms of earnings, yeah, I think a lot of this move in the market, according to our fundamental strategists, has been more related to a multiple compression than it has been earnings at this point in time. And there's no doubt that when you look at Washington, there is a lot of uncertainty being created at this point in time, but it appears to be more noise than anything else at this point in time. And I think a lot of institutional investors have already adjusted their portfolios, taken down gross, and at this point in time, they're probably looking to put money back to work. Because, Frank, there's a lot of stocks that have pulled back to big, longer-term identifiable support that should be bought in here, not sold.
All right. So you're also saying that people should look kind of down cap at smaller cap stocks. And you're also, speaking of D.C., you're just talking about D.C., you say there's some historical precedent for small caps during the first year of a president's term, the inauguration year, basically. Kind of lay that out. And do you see that historical precedent kind of repeating itself this time around?
Yeah, I mean, there's a couple things there to really unpack. You know, first and foremost, when we go back and we look at Trump 1.0 versus Trump 2.0, and we look at the macro layout on that, a lot of it looks fairly similar when you're looking at the dollar, when you're looking at yields, when you're looking at the S&P 500. Keep in mind, there's a lot of concern out there right now, but we still did see the market meaningfully higher in the first year of Trump 1.0. In fact, we did see the S&P up, was about 17, 18%, if my memory serves me, in that very first year. Would not be surprised to see some strength later on. And then also, if you take the first year of all presidencies going back, we typically find that the Russell 2000 outperforms the S&P 500 in those first years. And we also find that you typically are weak from about January to about April, May timeframe. And then you start to see the market understand the messaging, the what's changing in the marketplace, and you start moving higher.
All right, Craig, we're almost out of time. I have to ask you one other quick question. You also see U.S. markets catching up with international markets very quickly. What's the catalyst for that catch-up?
I think the catalyst of that catch-up is going to be some of the noise in Washington settling down because not a lot has changed. And keep in mind, post the great financial crisis, international markets have only really outperformed the U.S. about 25% of the time. I'll bet on the U.S. all day long, Frank.